right, so we will continue with our session from the previous day, which is when we were covering decision problem. The attendance problem has now been solved. I've given you the link to the attendance file. You will have view rights. So let's look at this, still sticking on decision problems. We were looking at decision problem 6.1, how to exit at a profit, how to determine the prices at which you would exit at a profit. Let's blow this up here. All right, so the first approach was to look at direct and indirect solutions. So we already did the indirect solution, which is trading stop orders. Then we did the direct solution where we went through certain steps. So we didn't complete all the steps, and I'll quickly, once again today, will as a type of recap, we will also once again quickly run through the, now I've written down the steps here. So this is the outline of the steps, and then so you have the, to understand the steps. Please don't memorize any of this. It's all logical, okay? Don't memorize anything. Pretty much anything I teach you is not to be memorized, it is to be understood. And then if you don't understand logic, I mean, in the sense that everyone understands logic, but if it is not flowing logically for you, you have to ask me, rather than trying to just blindly memorize it, because you will need this. Remember that even in IPM, even in the FDRM exam, you can be examined on material that was taught to you in IPM. So these are not taught as three different courses. These are actually one continuous course with three different parts. So you have to remember everything, all the basic stuff that has been taught to you, you have to remember. So therefore you make sure that you don't memorize anything. Okay, this is just for your recap while you're trying to understand the process. Okay, so what did we do? The logical steps. Now what are we trying to find out? Okay, what we're trying to find out is something like this. If if let's say we were long, this is the decision problem that we gave you. This is actually SPY, which is the ETF for the S&P 500 index, the ETF that tracks the index. So let's say you were long at this price. You went long at this price. Now the market is here. Now the question for you is at what price? So you're obviously making money. You went long here. But the question is, well, should you take your profit now? Or should you, that's the question that you have to take. And at what price should you exit? Should you exit at this point? Should you set it at 375? So that's the kind of question that we are dealing with. That's a decision problem, because you could decide it in multiple ways. And you could solve the problem in multiple ways. But the moment you choose one, you leave out all the other options. So these are mutually exclusive decision or actions that you take to solve a decision problem. So therefore it's a decision problem because these are mutually exclusive. Okay, so let's go back to this. Here. So the first thing we said is you have to find out the percentage, the target ROIC. Okay, where do you get that? You get that. This is all recap. We've done it before. You get it either directly from the investor. The investor tells you, I need so much. Or you get it from the fund manager himself decides that I would target a particular ROIC. I will market my fund by saying I'm targeting a 12% return, because he believes that there is a market for this kind of a fund. There will be investors who will be attracted by this kind of a target ROIC. Okay, so whenever there's an indirect investor mandate, he's basically estimating that there's, he's surmising that there is a certain category, a customer segment that will find this appealing, and that's why he's doing it. Okay, so once you get the required ROIC, you calculate the target gross profit. This is all for any given period. Okay, I'm not writing that. It's understood. Everything is for a given period. Calculate it. How do you calculate gross profit? Is this target gross profit is, but this is the definition of gross profit. Is target ROIC times invested capital. This information is available with you when you're launching your fund. You know what the invested capital is. Here in this case it is 5 million. So you take this and you take 112.5% into the invested capital figure, and then you get your target gross profit. Okay, so it's all recap that is happening quickly, just to put everything in one session. neatly. All right, the third is, maybe we should put some coloring here to make it stand out a little bit. The third is, and put everything in bold. We don't have to put everything in bold if we're coloring it. Okay, so, all right, the third is, okay, so you calculate the target gross profit. Okay, once you get that, then you estimate the trading system parameters, which is all these things like you have to project. Estimate trading system parameters, which means you're looking at, you have to project the number of trades, what percentage will be losers. Okay, from there you get the number of losing and winning trades and the winning percentage, percentage winners, you get all that. And you also have to talk about the percentage of the invested capital, that is risk capital. In this case, I've taken it as 100%. So RC is also $5 million. So we do that. This is the step estimate trading system parameters. You're familiar with this. Then number 4 is calculate system edge. We've gone through system edge the previous time. It's not really a new system. It's not really a new calculation. What I showed you the other day in our FDRM calc in the session board, we said basically is that this is actually what everybody learns first, the weighted average. Okay, so mathematical expectation is the second thing that you learn. Okay, when you come to statistics. But the point I'm trying to make is that these three are all the same. So system edge, just copy that from here. System edge, mathematical expectation, and weighted average. Okay. The point. This is what I want you to understand. This is what I mean typically by conceptual clarity. You should have this very clearly in your head that these are all actually the same. All right. This is mathematical expectation is nothing but a what we call a probability weighted average outcome. When you do this, sorry, that average spelling is not correct. So the right way to think about mathematical expectation is as a probability weighted average outcome. We can put it here. Yeah, okay. So this is how it is. This is the right way to think about it. So in fact, therefore, mathematical expectation is also just a weighted average. So there's nothing new that is happening here. You all know weighted average from your school maths classes. And then all we are doing when we introduce mathematical expectation in statistics is that we are telling you now that this is it's also a weighted average, but it's a probability weighted average outcome. So rainfall in Delhi, different chances of rainfall, quantum of rainfall, the probability of this quantum of rainfall happening. And all you're doing here is you're computing this as the probability weighted average outcome. Okay, so this is basically it. So that I want you to understand that these are all the same. And in system edge also, it'll help you to remember stuff much better if you can understand the essential oneness of all these things. These are all the same. System edge, what are we doing in system edge? We are defining system edge as, look at this, percentage losers into average loss. Okay, so this edge is nothing but the average outcome of the system. Okay, which is average loss is the average loss outcome, average profit is average profit outcome, percentage winners and percentage losers. These are the proxies from the probabilities. Okay, so if you either take an ex ante perspective or an ex post perspective, okay, both are relevant. Usually we are more concerned with the projected number. So this is your expected loss percentage and win percentage. So these are probabilities. Okay, this is related to the idea that I mentioned here, the what we call the frequentist view of probability versus the Bayesian probability approach. So here we are applying more of a frequentist approach. And so these are actually probabilities. So now you can see why we say that system edge is a very common trade term that is used in the industry for trading systems. So people ask you, what is the edge of your system? This is what they're talking about. Okay, the mathematical expectation of the system. Why? Because mathematical expectation is a probability weighted average outcome. And what you have here is probabilities, average outcome, probability, average outcome. Okay, so therefore it's the same thing. Okay, so we've already done this before, but I'm just once again repeating that for you. So we do that. And I think where we stopped the other day is we also defined a very important term called the reward to risk ratio. Okay, you can also, sometimes many people call it a risk reward ratio, more commonly referred to as risk reward ratio. Doesn't matter what you call it, risk reward. If it's risk reward, then you have to put average loss on top, average win at the bottom. But I prefer to call it reward to risk because I think it's more meaningful that way. So in that case, you put the average win on top and the average loss at the bottom. You can use any approach, but you have to be clear, make sure that you communicate clearly to other people what you're using, and then you have to be consistent, okay? Be consistent and specify. This is what we are saying when you talk about this, okay? Reward to risk ratio. Now, what do we have here? So this is where we stopped the other day. System edge, very important to understand it conceptually. Once you understand, yes, Shaurya?
Nothing, sir. Sorry.
You need to mute yourself. Okay, all right. Okay, so this is where we stop. Mathematical expectation, make sure you understand it conceptually, and also understand if you have any confusion about it, you have to ask me. You understand why I said this, make sure you understand why I'm saying this, that these are all the same. Weighted average, mathematical expectation, and system edge. All of these are the same thing. You should understand that for yourself. We'll put them all in one box. They are all the same. And we'll put some nice color around the box. Okay. Out of which, yeah, so this is also a probability weighted average outcome, but we'll talk about mathematical expectation. Okay, so next step, what is the next step? Calculate target gross profit, fine. Estimate trading system, calculate system edge. Okay, so let's see what we are doing here. What are we doing here? No, R3. So this sheet where we are doing these calculations, this is called R3 because I wanted to use a short name. And by now you know what R3 means. Okay, R3 is. What is R3? Akshita, what is R3? I'm asking Akshita, what is R3? What happened? So she's also sleeping. So very often we find that people are sleeping. Okay, let's, okay, never mind. We'll continue with this. So R3, yes, Vipul?
Sir, risk return ratio.
Not risk return ratio. You go with the way I've taught you. So you say reward to risk ratio.
Reward to risk ratio.
Okay. So yeah, it is risk return is also not wrong. What you're saying is not wrong, but you're turning it, putting the risk on top. But it's okay. But we stick to the initially, at least when you're learning, stick to what I'm teaching. So we got that. We got so this is called R3 in your sheet. Okay. So we did the target return. We got this. We got the target gross profit. We got the number of trades. And from here, we're going to figure out the system edge. How do we calculate the system edge? So let's figure out, we know the formula for system edge. And one of the things that we are telling you here is that the system edge into the number of trades is the gross profit, okay? And this also reconfirms to you why the system edge is the average outcome. So this is the average outcome, okay? So if every player on the team scores 15 runs and then there are 10 players, okay? Then you take 15 into 10 and then you get the total number of runs scored is 150, okay? So the same way, we can say that because we know that SE is average outcome of the trading system, So we can say that SE into number of trades will equal the total profit of the system. Here, this is a kind of a gross profit, which means total winning trades minus total losing trades. Okay, this can be negative also. SE can be negative if you have, if either you have more losing trades than winning trades, which can happen quite often. But also remember that there's another thing here, which is that it's not just about whether you lose more money or you win more, where you have more winners or more losers. There's another very big element in that, which is the R3. That is ratio of average loss to average profit. So if you have the R3, if you have a predetermined level for R3, you can actually state, in this case, we're determining the average profit. That's the whole point of this exercise. But in certain cases where you have a predetermined figure for R3, here we are trying to determine the average win. The whole point of all this exercise, these exercises that we're doing, is to determine the average win, because we are trying to look at the exit price. Where should I exit? And that's connected to the idea of the average win on the trade. Okay, so the target, the total profit target on a particular trade, that's the average win. Okay, so that's what we're trying to. So that's we're trying to find the average win. We already know the average loss from the trading system parameters calculation. So we're trying to find out. But if you have R3 already preset in your mind, okay, that every time I'm going to use a R3 of 7, okay, then you can actually rewrite this as average loss here and percentage winners into 7 times average loss. Okay, so basically you can rewrite this. Let me write this down here for you so that you understand this concept. This should be written here actually. Okay, we will write it down here. Very important actually to understand this other aspect. So once we know what R3 is, okay, so what we say is that so we can also write, all I'm doing now is I'm going to replace average profit with R3. Okay, so I'm going to write see, look at this, average win by average loss is equal to R3. So I can say that average win is equal to R3 average loss.
R3 to average loss.
Okay, R3 to average loss. Okay, so let me just do this here also so that we have this clear. Or we say, or average win equal to R3 times average loss. Okay, so we're going to use this relationship here, and we can also write, therefore, since make it very clear to everybody, since average loss, and so into this is average loss. You write this as average loss, and we'll put this. So bracketing is not exactly ideal conventions, but what we are doing is here R3 into average loss. We don't need to actually put this up, but we'll put it up anyway as a second bracket. Make it nice and neat. All right, so what we are doing now is we are writing further average win as a function of R3 and average loss. So we are writing this. Now, the point of writing all this is basically to highlight to you that if you look at, as you start browsing, market related sites and you go to financial market websites and stuff like that, people will start serving you internet ads on trading systems. Okay, and you will find that very often you may have already encountered this when you're watching market-related financial markets news on YouTube and stuff. They will try to sell you trading systems with, and when they sell you trading systems, they will try to, let me just open this session notes also. Sometimes you may want to use the session notes. Certain types of system edge. And so here, 1 minute, where are we? Yeah, we can also write this. Okay, so I'll write it here itself, since we are just talking about trading systems, okay, and system edge. So typically you will notice that when people talk about trading system, when they're trying to market trading systems, remember, all marketing is about manipulating customers, okay, consumer psychology. They are manipulating it. So therefore what they will try to do is they'll try to manipulate your psychology as a human being. So percentage winners in a trading system percentage winners is not the only important factor. Okay, let's take some of their autocomplete. R3 is also important. All right, R3 is also key. Let's put it key, short word. Okay, so you can have a system which will have very low percentage winners. Okay? But if it has a high R3, I hope you can see this. Okay, now this term comes out with a negative. Okay, because we write this whole thing as, in this case, actually I've written it because we write the later on I've told you to write the average loss with a negative. Okay, so this actually should be slightly better written. It should be written as, if you write the average loss, either you write the average loss as a negative, or we can actually make it better and we can write it as -1 into average loss. Okay, so yeah, okay, so this term will always come out as a negative, okay, and this term will come out as a positive. Now the question is, does the positive outweigh the negative? So the point we're trying to emphasize, you'll notice when they try to market trading systems, all the ads will talk about 80% win rate. You'll see this 80% win rate. Okay, first of all, that's very unrealistic. Second, is that's not the only thing that matters in a trading system. R3 is also very important. So you could have a very low win rate, but you could have a massive R3, and that will still make the difference. Okay, so as you can see in this system also, let's have a look at this trading system. It's got only a 25% win rate. Okay, so percentage winners is 25%. Okay, we can put this in. Usually I put, maybe I shouldn't put such a deep color. I put a brownish kind of color to indicate, yeah, that it's a derived number. Okay, so you see percentage winners is very low. Okay, but let's look at this. Where is the R3? Where is the R3? R3 is 6. See, reward to risk ratio is 6, which means average win divided by average loss is 6. So if you see this, okay, assuming that the system actually works, assuming that these are ex post numbers, okay, ex post numbers, somebody is trying to market a system, usually they will look at ex post numbers on some kind of simulated trading. And you look at the system and you see, okay, oh wow, most people would look at this 25% win rate. This must be a useless system, okay? That it's not necessarily true, because you can see the system still has, because it has a very high R3, it still has a reasonable system edge, okay? The 31, on average, it makes 31.25, profit. Okay, you can actually also look at this. This is not really dollar risk per trade, but you can look at it somewhere else, which is, maybe you can look at it here. You can also look at this, this 31.25 as a function of your invested capital. and you look at percentage of that. Okay, so you can see that on average, this system generates 0.63% per trade, okay, of the invested capital. So it's not a bad system as such. If you look only at percentage winners, it would look like a disaster of a system. So what the main point of this entire discussion is this very important thing to understand, because understand system edge, won't understand. Usually what happens is because these marketers are trying to manipulate you. So they will talk about percentage winners, and most people think about percentage winners only. That's because most people have not been trained like you guys are being trained now. They have not been trained to look at things like system edge. Okay, so that's the important part here. So compute system edge. Okay, so we got the system edge. So what we do now,
Sir,
go ahead.
sir, this 0.63% is the winning probability per trade.
No. It's not really the winning probability per trade is this 25%, because
20.
in your distribution of trades, 180 trades, you had 135 losers, 45.
Yes, sir.
Winning percentage is 25%. Okay.
Okay.
This one is actually all I'm showing you here is this is nothing but the micro level, the per trade equivalent of this number. This system has generated this much return on invested capital. And that's another way of looking at it, okay? That if you do 180 trades and per trades, you can check this out here. You'll see that if you take this, I think it should work out. If you take this into, yeah, this is this. If you take this and then you do minus, okay, -1 obviously.
One last one. Yes.
I've deducted one. Here we don't need to deduct 1 in this case. This is 112.5. Let's look at the equivalence. Okay. So all I'm doing is this is per trade. Per trade, on an average trade, this system generates a return of this percentage of the IC. And so when you do 180 trades, 180 into this gives you 112%, 112.5%, which is basically what this system has generated on as a total return on IC.
Yes, sir. Basically the target.
Yeah, target. In this case, we are doing an ex ante analysis. Target. Once you do ex post, it's no longer a target. It is
yes.
Okay. Ex post, you'll be talking about what did I do last year. So that becomes actual, realized.
Okay, sir.
We are doing ex ante.
Yes, sir.
Okay. So the point here, you can see once again that now these are all mathematical. So there is nothing, and if these numbers assumptions are correct, then these numbers are also correct. Okay. So what you can see clearly, one important learning here about system edge, I'm just hammering home the same point once again. Okay, that even though the system has such a poor win rate, look at it, 25%. But just by having R3 of 6, R3 of 6 is a little tough to do, I would say, in real life trading, but it's not difficult. Actually, it can be done. Okay, you need to be disciplined. You need to give it some time. It can be done. So if you can see with such a pathetic win rate, but just by having an R3 of 6, you can produce such a phenomenal return. Most people would die for this kind of return. Okay, so if a fund makes like 30% return, it's considered like it's a major achievement. So this is like a blockbuster return. So you can imagine. In fact, maybe you can play around with this. You construct your own spreadsheet like this. Okay, and you should do it yourself. If you just copy my spreadsheet, then it doesn't really help. You don't learn anything. You have to understand the concept. You can refer to my spreadsheet. So just to check that your numbers are correct, you keep it on a screen as a check, and then you should construct your own sheet. Then you really learn. Okay, even for the notes, you should write your own notes, and then you'll learn. Otherwise, you'll not learn. If you just try to mug it up at the end of the course before the exam, there's no learning involved, and then you're wasting your time. Okay, so very important lesson to learn that don't just look at this, also look at this. So we do this compute the system edge using this relationship that system edge. So to calculate the system edge, you can actually take the gross profit divided by the number of trades, and you'll get the system edge. So that's what we're doing. Step number 4, calculate system edge. What did we do? We know the number of trades, and we know what is the target gross profit. So we just take this. System edge becomes target gross profit by number of trades. Okay, so we get the system edge. Now what do we do? Next step. So then we have here a discussion on system edge.
Sir?
Yeah.
Sir, so can we say that all the calculations we did in the system edge are a way to cross-check if we are going on the right track or not? Like, will we be able to meet our targets or not?
Yeah, you can say that. I mean, the system edge is to some extent also giving you a good idea about your, basically what system edge is something we are interested in it as a general principle also, because one of the first things that people will ask you if you're trying to, let's say you're going to a investor with a plan and you're trying to say to the investor, please give me your money to manage, okay? And you say that I'm going to manage it using my trading system. So one of the things the investor might ask you is, so what is your system edge? Okay, so the system edge contains some important information like this, okay, average loss, R3, okay. So these important things are contained in the trading system. So yeah, to some extent it does give you, and there are other things that go into the trading system, all these things, estimates that you're making, average loss, okay. Some of these come out of the trading system itself. The system edge is almost like a mechanical calculation. If you look at the inputs of the system edge, percentage losers, average loss, okay. Average loss is a function of your risk capital. If you see here, average loss, okay, average loss or maximum risk per trade, it's actually a function of risk capital. G15 I've put it as, and G15 will come out of dividing the run of losers, which is G16. Using G16 in the denominator, and G8 will be your risk capital. You look at G8, that's your risk capital. So you take the risk capital. So answer to your question is yes, system edge gives you some important information for what the performance is likely to be, ex-ante system edge calculation. But also remember that the inputs for the system edge calculation, they come out of the actual dynamics of the trading system. When you do in step 5, this actually should be put in. This is the detailed discussion. Okay. So when you do this, okay, trading system parameters, percentage trade, number of trades, percentage losers, risk capital. I've not put everything here. Invested capital, risk capital. What is the percentage of IC, that is RC? All these calculations have an important element bearing on the system edge calculus. So the broader answer to your question is yes, system edge also gives you that information, but you have to look at other information also from your step 3, the trading system parameter estimation. That is also going to give you very important information. Is that clear, Sushti?
Yes, sir. Obviously, if these values would be realistic, then only system edge would be realistic and we'll be able to have a better idea.
Yeah, correct.
Because these are the only values we are taking into consideration while calculating.
Very good. So that's basically, but these things go into the system edge calculation. So this is very important that you mentioned that this word realistic. Okay. Why do you think I'm pushing you guys to always put a high number over here? Because actually, now this is an ex-ante calculation. So nobody really knows what's going to happen in the future. Okay. Your actual percentage losers will probably be less than this, but it is better to take a more conservative estimate. Like if you're starting a business, if it is actually most likely that after 3 years you'll start making money. But in that case, I would say, why don't you do the business calculation by assuming that you lose money for 5 years, so that it's safe. In the sense, if you think realistically, after 3 years you start making money, then you assume that you'll start making money only after 5 years, so that you have enough capital, just in case your 3-year estimate. So it's a little bit of a buffer, basically, like a stress test, etc. Or, so if you think that it's actually going to be 3 years, you assume it's going to be 5 years. So you have enough capital for 5 years of losses, which means there's no chance of running out of capital. Okay, so that's why you're hitting on Srishti's word, realistic. That's why I push you guys to put this at a high number, so that you don't have any negative surprise. Because what you don't want in business is negative surprises. So a negative is okay, but it should not be a negative surprise. So if I lose money, that's fine, but it should be, I have a loss budget for every year. Okay, so it doesn't matter if you lose money for the full year also, but the loss must be within your loss budget. If you budgeted a maximum loss of $2 million and then you lose 7 million, now that's a problem. If you budget for a loss of 2 million and you lose 400,000, that's okay. I mean, you can live with that because you were ready for 2 million. So this is what I'm saying. So this is, yeah, in response to your question. Okay. All right. So estimate trading system parameters, calculate system edge. We got that. Okay. So there's a system edge calculation. Then what is the next step? Okay. That was step 5, right? Yeah. System edge. Now step 5. From system edge, we can compute average win. Okay. So I'm just writing this kind of average W is average win. Okay. So here we know this. Okay. So from here, this is just a little bit of algebraic manipulation. I think we went through this also, right? We went through this. Yeah, I think I showed you this. Okay. That this part also we did. So we have system edge. Average win is this. Final solution. Average win is this. So in what I've done here is I want to compute the average win, right? I want to compute the average win. So let's give this the kind of a, yeah. So I want to compute the average win. So I put the two arguments separately here. So this is the first part here. The numerator and the denominator is 1 minus percentage L. I put that here. So this basically is this minus. Actually, maybe I should just make this a little bit lighter because it'll be easier for you guys to see. Otherwise, all right, so what we have is, so we have average win coming out of this. So what we have is just nothing but numerator by denominator. And this comes out of this equation. So this, I think up until here, we covered the other day. This is nothing. This comes out from just from this table, from this expression. Okay. From the system edge, you can just express average win as a function of system edge, average loss, and percentage losers. Okay. So you can see once again in this situation, learn the language. Okay. I'll put it here. Above, I want to make sure that you understand. I think I mentioned this to you before. Modeling average win as a, I think we have it down below also, as a function of SE SE, average loss, and what is it? Percentage loss. All right. So also be very clear about the language, because nowadays financial modeling has become a buzzword. You know, even the auto rickshaw drivers, he's cut out Jai Matara from the back of his truck auto and he's put financial modeling. So everybody's using it. So you have to use, so you have to make sure you understand what this language is. So here what we say is we are modeling, although we put it on the RHS. Normally we like to put it on the LHS. You can flip it around. What we are doing here is we are modeling average. So the way we use the language is we are modeling average win as a function of 1, 2, 3. So dependent variable, what we model is the dependent variable, and these are the as a function of the independent variables. Okay, so make sure you get the language clear to understand how the language is used. All right. Okay, so next step is from average win, compute exit price. This part we didn't do the other day. So we have actually spent most of our time, a lot of our time recapping some stuff, but it's okay. We can make sure that we understand it. We've already spent 45 minutes about recapping material from before. But this is an important type, these are important calculations and you have to understand them properly. And you will not find them in most finance books because they don't handle, they don't deal with these kind of aspects. So in the textbooks. So here we have this. Now last part, our job is not yet done, because remember, what is the purpose of all these exercises? The purpose of all these exercises is to compute the exit price, or calculate, you can say calculate. Maybe that's a better way to do it. Calculate the exit price. What is our original problem? Let's never lose sight of the decision problem that you're trying to solve. What is the problem? I went long here, the market is here. At what price should I target to exit? Right now I'm discussing the direct solution to 6.1. So I'm not talking about using trailing stops. I'm talking about determining a limit price. If you look at the video for last session, I have actually called it setting limit prices for take profit orders. Okay, so now really that's our decision problem. What should be the limit price for my take profit order? Should it be 360? Should it be 375? Should it be 400? Okay, so that's our goal. That's what we're trying to find out. So what do we have? So last step, from average win, we are going to calculate the exit price. Okay, P plus exit price at profit. Okay, so we are going to consider the second scenario, which we looked at in IPM, which is we are sticking with the foreign exchange markets for profit calculations, because those scenarios are the most complicated. If you can do it for foreign exchange markets, you'll do it for any market like commodities or equities or bonds. So what we're doing is we're taking scenario 2 from the profit calculations, the position size calculations from last semester. So let's look at it. This is the last thing. So what we have to do is, now we've got this average win. From average win, we have to calculate the exit price. Okay, so this is basically going to be the limit price for our take profit order. Okay, so the limit price is nothing but, let me just clarify this once again, by reference to, write it here. So if you go back to your DP5, okay, if we just quickly check our DP5, you will see that under DP5 you will find that there is one parameter in a limit order. Okay, so limit price is the one parameter for a limit order. Let me see if I can save myself the work. And you see here that number of parameters in a limit order is 1. Okay, so when you place a limit order, so when we say number of parameters, we don't include buy sell. Okay, this concept of buy sell, whether the direction of the order, okay, or the transaction type buy sell, that's not considered a parameter. That is understood that in every order there will be a buy sell element. You have to specify whether it's a buy order or sell order. So we don't consider that as a parameter. Other than that, is one parameter. Okay, so in a limit order, you have one parameter. So that's what we are talking about. The limit price is the one parameter for a limit order. Okay. So when you go to an IBTWS and try to place a limit sell order, limit buy order, it will ask you for a limit price. So that's the price. So which means the system is asking you, okay, I want to sell SPY. I want to sell a limit. I want to set a limit sell order for SPY, and it will give me a blank slot to enter my limit price. And if I enter say 375, then it will sell SPY for me at 375 or better. Okay. So the next price is 380, and it can trade at 380. We'll sell it at 380 because it's a limit price. So limit order means at that price or better. So limit price is the one parameter for a limit order. So here we are modeling limit price for the take profit order, okay, as a function of, in this case, using average win. How do we do this? We go back to scenario 2 in our IPM calculations, where we did, which we did last semester, where we are saying, remember we modeled the trade PNL, very simple. Trade PNL, if it was scenario 1, very simple situation, where the trading profit, where the PNL is, where the PNL is being generated. Remember, you have to remember certain things. PNL is generated in the terms currency. This is all there in your notes from last semester. PNL is generated in the terms currency. You should have understood this by now. And in certain cases where your risk capital currency, we assume that risk capital currency is, we'll write that here. Okay, so in this case, let's ask Rajat. In USD CAD, what is the terms currency? What happened to Rajat? He has also fallen asleep. Yes. Okay, let's ask Varun. In USD CAD, what is the terms currency? Dollar Canada. When we trade dollar Canada in the spot OTC. Yeah, 1 minute. Yes, Varun. Okay, lots of people have raised their hands. Let's first ask Gagan. Gagan is not so active. Yes, Gagan.
Sir, CAD.
CAD is the terms currency. Very good. Okay, Srishti, what is your? Okay, I've already given out the answer, so there's no point. Anyway, I'm sure you had the.
Yes, sir.
Okay. So, all right. So the answer is CAD. Okay, so USD CAD. So there's some disturbance in the background. USD CAD. So the PNL is going to be generated in CAD. So the reason I looked at this, the second scenario, if you go back, you can find these calculations here. Remember, I repeated this spreadsheet in this semester's worksheet. So this you're already familiar with. So if we had taken this here, the terms currency is dollars. So risk cap and PNL currency and risk cap currency are the same. So no need for adjusting. Okay. In that case, your formula would not contain this part. Your formula would not contain this part. But since in this case in scenario 2, which is here, okay, in the number of units sheet, scenario 2, dollar Canada, PNL currency is Canada, and risk cap currency is PNL currency is Canada, risk cap currency is dollars, so USD. So there is a need for adjusting. So this PNL that is generated, this is your basic PNL expression, position times exit minus entry. Okay, that has to be adjusted to convert the PNL because we always want the PNL in the risk cap currency. All right, so okay, so therefore we have to adjust it. We have to divide the risk cap currency by the exit price. Okay, so that's the dollar value of that will give you the dollar value of the loss or the profit at the time of exit. Okay, so here I've written exit P plus. It's generally the general expression for PNL is position times exit price minus entry price. Okay, So we calculate exit price in two different contexts. One is the 6.1, one is 6.2, which is the more important, when we calculate maximum risk per trade, etc. Okay, exit price per with loss. That's the one. And then the other one is exit price with profit. So I've written it here. Since here right now our context is profit, so I've written it as exit P plus, but doesn't matter, it's the same expression. So therefore this all is P plus. So we do this. So from here you can see, you can follow these calculations. Eventually, I'm not going to go through this. If there's any mistake here, you can tell me. It's a little weird to look at maths like this, because we're not used to looking at these kind of expressions. We're used to doing them by hand, and they look different. So it looks a little weird, but you can see it. You can figure it out. So eventually, it'll come out with a result where, what are we doing? Modeling limit price. Okay. So this is your limit price on the take profit order. So eventually, you'll get exit price, profit, as a function of these. So here you have 1, 2, and 3. 3 different variables. Okay, three independent variables. So where do these numbers come from? Let's be clear about this. Profit or P&L. Okay, here, remember, where did this come from? Okay, here if you look at average win, okay, you've already come out with average win before. Okay, in the previous step you got the average win. So this profit here, let's make that clear. Okay, is average win, which you got in the previous step. Okay, you got that in the previous step. So you got that. You take that output of the previous step as input in this step. Okay, so this part is clear. So let's be clear. When you have a model, another thing to look out for, obviously, when you are evaluating a model, here, this is the dependent variable. Okay, that will come out as an output. Then you have independent variables. Make sure your independent variables, ideally, in an ideally good model, independent variables will be directly observable. Okay, so if you look at your things like cost of equity and all that, those are very bad models, like the CFPM cost of equity, because the independent variables are not clearly observable. Okay, so if I have a model where I'm forecasting today's rainfall in Delhi as a function of last week's, of 7 days ago, snowfall in say Shimla. If that's my model, then, well, the snowfall in Shimla 7 days ago, that's easily observable. I can go to the Met Office website. I can get a hard objective data point for that. Okay, so that's very important also in any kind of modeling, that make sure you don't create stupid models like this CAPM cost of equity model, because this doesn't have hard objective data for the independent variables. Okay, you always want to have a model where independent variables are easily observable. Like the example I gave you, what was the snowfall in Shimla seven days ago? You can go to the Met Office and figure it out. It's objective. There's no subjectivity involved in that. Okay, I hope you've understood this point. It's a sufficiently important point, so let me make that here. I think we have got a section on models also, but I'll make that point here, that calculate exit price. In an ideal model, in the these are the characteristics, because what will happen is, if you go into the financial services industry, because models and modeling and all that, this is big business actually. that people are always going to come and try to sell you this model and that model, okay, and this trading system and that trading system. And so one of the ways you can critically evaluate models is to look at, there are other points also that let me add that here also, since although we have not discussed too much about it. Plus, in an ideal model, since I don't know when we'll have the discussion once again, and these are so important. And let me give you that input right now. Independent variables should be easily observable as objective data. You understood what I mean by that, okay? So snowfall in Shimla 7 days ago is an example of objective observable data. Okay. Now, independent. Second one is predictive model. Okay, ideal model. Okay. An ideal model, let's say independent variables should not be. This is because you may actually have to use this information already before we get to discussing models in our thing. There should not be too many independent variables. Okay, we'll put a bracket here. Mostly in finance, we are interested in predictive models. Okay, so not in explanatory models. So there should not be too many independent variables. There are two important points about models, which I thought in passing, although we are not discussing models right now, I thought I would just mention because these are very important. And you may need to use these ideas before we get to discussing models. Okay, so we got this now. Exit price is equal to this. Now let's see how we can, any questions so far? How we got exit price as a function. So in this step number 6, we had a lot of discussions about models in general. Okay, but we also, what we got was, as a function of this and a few other things, we calculated the exit price at a profit, at the limit price for take profit order. Any questions so far? Okay, good. So let's put this into action. Okay, so we got average win. Let's see if we got the average win. Have we got the average win? Yeah, we got the average win, right? Now let's put this into action. Where is the, yeah, so we are just doing a cross check actually, where we are just cross checking and making sure that this average win is consistent with the system edge, which is here 31,250. There's also 31,250, and the R3 here. Okay, the R3 here is average win by average loss. We got the R3 of 6. Okay. Now let's see, what we are going to do is we are going to make use of this. Okay, and we are going to take an actual scenario like scenario 2 in Canada. Okay, where is the dollar Canada right now? I wrote this a little bit earlier. It's gone up a lot actually. So it doesn't matter. We can just assume that it's at a different place, and we just assume that it's dollar Canada. What we are going to do now is to show you how we can actually take an actual example in dollar Canada, where we are calculating the exit price as a function of these. Okay, so let's look at this example. So here's an example where we have a position size which is calculated separately, okay, which is a function of these two. So this position size is consistent with this average loss and this number of losing trades in a row. Okay, so we assume that there are going to be 120 losing trades. And how did we come to this position? It's the same way we calculate position size on a trade, if you remember when we solved this one. I think we need this right now. If you remember when we solved this one, we told you how to calculate position size. So this is calculated in exactly the same way. This position size comes from, okay, we know this is given as an input entry price, exit price. These are inputs, okay, for us. No, I'm going to put blue there. Okay. So we are talking about entering a long position at 99.70, exiting the long position at 99 figure. This is called figure actually. 00 is called figure. So 99.70, 99 figure. So we enter at this price, we exit on loss. Notice exit P minus, exit on loss. So we are taking this. Then we take the same parameters. Risk capital is 5 million. Okay. And total number of losing trades in a row, maximum run of losers from the start is 120 trades. Okay. So we divide 120 by 5 million. Okay. And we get average loss, maximum risk per trade of 667. Okay. And then as a function of that, if you remember, the formula that we used to calculate the position size, you'll see here that this is the position size for this particular trade, which we are planning to do, 99.70, entry, exit on loss at 99. Okay. So you notice this is this by this. And what is the numerator? Let's check the numerator. The numerator is exit price times average loss. Okay, because the formula is average loss. We can show it to you here, but you can revise it also yours. The PNL, the formula is PNL or profit. In this case, we'll call it PNL because we're going back to a loss calculation. So PNL into this, okay, we're not going to do the calculation here, but obviously what that means is PNL into exit price, okay, and position. If you want to look at it, you can do it here once again. Position will be, as we'll just do it as one calculation here. Recap solution DP7. All right, DP7. Okay. Call it PNL here. Okay. Position times this. So this we are actually what we are recapping is this exercise. We are recapping this exercise. Okay. So what we did here is this. So therefore we can say position is equal to, I'll just do it directly in one step to save time. We can say position is equal to PNL sorry. Let's say this PNL into PNL into exit price. Okay. PNL into exit price. I won't put too many brackets here. Okay. And divided by exit price minus entry price. Okay. No, that's what we have. Put another bracket. Okay, how do we, this is numerator, denominator, because we take PNL into exit price on the left, and then we have position on the right into this. So we just take this into thing on the left below, yeah, to the left side below. So therefore, PNL into exit price divided by exit minus entry. Okay, that's your position, position. This is what we're doing. So using this formula, we have determined the position size. Okay, so you can see here, this is PNL, which is the average loss per trade, maximum risk per trade, times exit price, okay, exit on loss, because right now we're determining the position size, divided by what? Next thing here, what is this? Exit minus entry. See, exit minus entry, okay. So these are just the component calculations, that's why I put them in small caps. And then this is the result, divide the numerator by the denominator, and then you get the position size. So now you have some important information. This is a pre-trade, you can think of the whole thing as pre-trade planning. Okay, so first you plan the position size, because you look at the market and you figure out this is going to be my entry, this is going to be my exit. Okay, now having figured that out, now you need to solve DP7. what's going to be my position size. This is how you solve it. You come out. So now you have some important information. DP7, entry price is DP5 actually. Exit price is DP 6.2, exit on loss. Now you need DP 6.1, exit on profit. That's what we're trying to solve over here. Okay. So now we are going to use the information we got here. Where do we get this information? Here. We are going to now calculate exit price. Now we're going to use this formula. Maybe the final solution we can put in bold. Right. We're going to use this formula to calculate. So very easy. We just put this into the spreadsheet. Okay, position into entry divided by position minus profit. Okay. So the question here is, if this is my, these are my system requirements, I need to generate this much return. Okay. What is the exit at which? What is the price at which I should exit with a profit? Okay. So I do this. I have position into entry divided by position minus profit. Okay. Position into entry price, I've labeled it here. So it's here. Okay. Position into entry. Okay. So this is a little bit like commenting. Remember that a spreadsheet is for those of you who are actually dabbling a little bit about into programming and stuff. Okay. Make sure you do it in a very fundamental approach. Don't try to do shortcuts. So this is a little bit like what we call comments. In a program, there is something called comments. Okay. So if you look at a good book like Elements of Programming Style, etc., they tell you to always put comments in your code so that you know what you have done at a particular point of time. Okay. So here what I'm doing is actually commenting on the code. This is all code, okay, by the way. So don't, when you do spreadsheets, you're already doing programming. It's a programming environment, okay. There are certain restrictions and rigidities, and there are certain pre-programmed subroutines. Like if you have IRR, that's actually a pre-programmed subroutine. Standard deviation, pre-programmed subroutine. These are, you just call up the subroutine and execute it. This is all a programming environment, okay? So what I'm doing is I'm doing comments. I'm writing down, what did I put over here? If I look at it, 3 years later, I'll get confused. What is this? So this is meant to help me. This is position into entry price. Okay, you can check it. Position into entry price. Okay. Next is position minus profit. Check it. Position minus profit. What is the profit? Yeah. Now, average win. Remember, average win you got out of here. This average win calculation, 250,000. Okay. So remember how the logic works. You started from this. The investor is telling you, I need this return. Okay. And so you know that he has given you 5 million as the invested capital. Well, if he wants this return, that means I have to produce a gross profit of this, which means my system edge has to be this, given I have 180 trades. If my system edge has to be this, then what has to be my average win? My average win has to be 250,000. So if 250,000 has to be my average win, then when I am looking at this trade, okay, then let's say whatever I buy at 99 and we can actually, what we'll do is we'll put this as all so that somewhere I can find the 99. Okay, so somewhere here we'll have the 99. Okay, so 97, somewhere here when I bought it, okay, with a small stop. Okay, then in that case, I have to figure out, okay, at what point should I exit? What should be my exit price? Well, the answer to that is determined by, you cannot just determine it arbitrarily. It has to be determined by how much the investor wants as a return. From that, all the way stepwise, you arrive at, on average, how much money do I have to make per trade to produce this kind of return? And the answer is 250,000. Okay, so this is this particular trade you're thinking about, entering here, exiting here. This is like any other trade. So this is an average trade. So you have to shoot for a profit of 250,000 on this trade. All right. So your risk per trade is 42K, and you have to shoot for 250,000. So therefore, what you do here is this, as you can see, position minus profit. Okay, this position is clear. Okay, minus profit. This profit is the same as this quarter million. Okay, because you need to produce that profit on this trade. So this is the position minus profit. Okay, so that gives you an exit price of 104.12. Let's say. Okay, so in Canada we don't at this point. It's not a display, so we can actually 104.12. Now let's see what happens when, let's cross check this. Okay, I'm using this as an input now. Okay, so I'm writing position times, okay, entry is I10, entry is I10, sorry, exit minus entry. Okay, so remember, now I'm cross checking using this formula. P&L, position times exit minus entry divided by exit. I'm using that formula to cross check. If I exit at this price, maybe I should not put such a deep orange on it. Maybe I should put a lighter orange. So you can actually see the, maybe here also. All right, okay. So if you see this, now you'll see this. What I'm doing is here. So this 250,000 profit, I'm modeling that. I can make this a little smaller so we can capture everything, and or I'll make it big. Yeah, now you can see it. Okay. So here, now you look at this. What am I doing? My answer is this. My exit price, dependent variable output from this modeling exercise is this. Now I'm cross-checking this. Is it correct? Okay. I'm cross-checking it. You should always cross-check. It's almost paranoid to do it, but it's good to be paranoid. Okay. In business, it's good to be paranoid. Okay. Now, what are we doing here? Position, the orange one, position times the P&L calculation, LHS P&L, RHS is this, position times exit minus entry divided by exit, because this is scenario 2, this is dollar Canada. So exit minus entry, the whole divided by exit price. Okay, so this whole divided by exit price, that's what we have. Position times this exit price. The answer that I just now got, I'm going to cross check that answer, use this exit price, this minus entry price I2 divided by same exit price. What is the answer? 250,000. It tallies with my average win requirement here. Okay, so therefore what we can have is, I'm going to make all this very light so that, yeah. So do you follow now? Are you following what we just did? We just derived, we solved this problem. The entire exercise which we had all the way from here, indirect solution we've already done. Okay. Now we are looking at the direct solution, active selection of specific exit price, limit order or market order. Mainly we are concerned with the limit order. Okay. So basically we are concerned with setting the, we can actually write it this way. Limit price for take profit order. This is basically what we learned here. That, yeah, under direct solution, active selection of specific exit price. Let's put it this way. Limit price. This is the real problem. Okay, setting the, setting the okay, so this is the real problem actually, determining the limit price for take profit order. All right. So this is what we have done. Right at the end, now you can see various steps. Okay. That, yeah, this we just did as a recap to show you how we came to that. But the main thing is that it ends over here. This is the exit price. Then we can put this also as in bold, where we come out with the average win. Okay. Now, this, it may not make much sense to you right now. I mean, because it's actually not very complicated, but there are many steps involved, and you have to be very careful. A lot of you, I'm noticing, even from correcting your answer sheets, many of you don't have attention to detail. This is very important actually. In business, I've seen many of you, I gave you instructions. This is one of the reasons I give you this kind of instruction. I give you specific instruction. Font size should be 14. Font type should be Meriwether. Okay. You should have date format like this. Many of you have not followed this. Now, what is going to happen is, if you're going back to your father's business, I guess no problem. Okay. But sorry, I'm just getting a sip of water. Okay. If you go into the corporate world and you make these kind of mistakes, these are not small things, okay? This will create a very bad impression. Remember that when you join a company, people will form their lasting impressions. First impressions matter. People will form their lasting impressions about you within 6 months. 6 to 9 months, people will figure out that this guy is useless or this guy is very good. And one of the things they're going to look at is, because initially when you're going to be fairly junior, you will get a lot of instructions, okay? Like, do it this way. And what I'm noticing in your evaluation is that many of you are failing to follow. I mean, what is so complicated? Like a 6-year-old child can do this. If I tell you, place 6 candles on the table, and then you can't even place 6 candles, you place 4 candles. I mean, you can't even follow simple instructions. So these are all examples of what we call sloppiness. If you go and do this. So part of the training, as I said, my goal here is to produce outstanding business students. Okay, I'm not necessarily trying to be popular or trying to be, overtly, on the surface very friendly to you or anything like that. But that's not my job. I'm the coach. My job is to produce outstanding players. So if I have to be tough on my team, then I'll be tough on my team, because we have to be clear about the goal. So one of the goals of giving you these kind of instructions is to make sure that you can at least follow these instructions, detailed instructions, long, detailed set of instructions, but you should be able to follow it 100%. There's no excuse for this. Okay, following instructions 100%. What is there? You just switch your brain off and mechanically follow the instructions. Even that people have not done. So I'm just giving you a warning. What will happen if you go and join the industry and you make these kind of mistakes? People will brand you as a sloppy person, and it will affect your brand image. Remember, when you go into a job, wherever you go, even without the job, even when you're coming to DSB as a student, you're a brand. Okay, so you're a brand. You're representing yourself. You're also representing your family. So remember all that. Okay. So everything you do, you should remember this. There's a famous baseball player who was told by one of his coaches that, remember, when you go on the field, that jersey that you're wearing, that is your father's name. On the back of that jersey is your father's name. Don't forget that. Okay. So this is very important to remember, that you are a brand. Everything that you're doing in an official capacity. When you're hanging out with your friends in a movie theater, that's cool. You can just be yourself. You can relax. You don't have to be so careful. But when you're interacting in a business environment, you have to be very careful about what you're doing, because it's all going to affect your brand. Okay. All right. So long lecture, but this lecture was required. Okay. We needed that lecture, because I'm noticing from your evaluations, and 2 people have not even submitted. So I had to give them the worst grades, because I had to submit the grades on Sunday. So 2 people did not even submit their project report. So this is what will happen. This will create a big negative impression in the corporate world. Okay, right. So let's go on now to what we have to do. So this part is done. So we have solved, now if you see, we have solved all these problems. These 3 are solved by the investor typically. Okay, indirect investor mandate or direct. Okay, this we have done. We will do more on this when we handle models. We will do a separate session on module on models, a little bit more, but we have done quite a bit of it. And okay, entry price we have done, exit price we have done. Remember, in a bare bones system, you don't need to worry about this. All entries are at market, and you don't need to worry about this, because in a bare bones very minimalistic system. You use the trailing stop method, and you don't have to solve exit price with profit. You solve it. You don't have to directly solve it. You solve it indirectly using trailing stops, which means what you're doing is you're actually just using the 6.2 solution on a repeated basis to proxy the solution for 6.1. So that's why we don't highlight this in a bare bone system. So then we have, then we also looked at entry price, separate decision, and market order, limit order, all these things. Then we looked at exit price with profit, the more important discussion. We had the discussion on trading stops. And we looked at the direct solution, which is basically determining the limit price for the take profit order. Now, again, you will find very often when people go long here, when it comes to the question of, maybe they put the stop here, when it comes to the question of, okay, at what price should I take my profit? Many people determine it, many people even in the industry, they determine it in a very arbitrary way. But actually, it is not right to do it that way. You can do a very, very logical calculation, and in a very structured way, you can come out with this limit price. Going back to what Srishti was hinting at earlier, that if this is the dynamic if your investor is demanding this kind of return, okay, and let's imagine that you're working with a R3 of, so when you know straight away that this kind of return if the investor is demanding, and if these are the characteristics of my trading system, if this is what the reality is that I'm projecting, this is what the investor wants, then I better have a R3 of 6, which means in this case, for this particular example, if I'm entering here, exiting here, I must wait until 104.12 before I take profit. So if the trade is moving into profit for me, I can't just straight away take profit here at 111.50. No, because then my average profit per trade target is not coming out. Average win target, I'm not achieving it. In order to achieve my average win target, which is connected to this, I will have to exit at 104.12 only, not before that. Okay. So this is a very important thing, because if you arbitrarily exit, then you are not in line. You're not in line with what is being demanded of you by the investor. So this is very important. There is the point of this whole exercise is to show you that there is a logical connection between this number and the larger exercise which we are doing, which is limit price for take profit order, trade by trade, because in real life you'll operate trade by trade. So where you so we are done for that, just finish it off. So the point of this very important lesson to understand is, although many people in industry will do this arbitrarily, but the lesson that you have learned is that it is not to be done arbitrarily. This number is to be calculated in a structured way, stepwise, starting from this number, and also with all these other numbers, trading system parameters, which we have seen in the steps. Okay, so we are done for now. The class is dismissed, and please make sure you keep doing your TWS. Keep logging into the system, because we are going to do another trade, another system project. Make sure you don't. It will become inactive if you don't log in for maybe, I think, 15, 20 days or something. Make sure you log in regularly, keep the system active. We're going to use the same login for the next project, which is equity option trading. I have already put the notes in your, you can start looking at the notes. Framework for US equity option trading. This is our next topic. Okay, we'll go into this from the next class. Okay, so class is dismissed, and those who have questions can stay back. Otherwise, you can leave. Any questions?
Yes, sir. Sir, will we be studying about the Greeks and the options which is mentioned in the outline?
Correct. Yeah. If you look at, you can already get a sense of what is going to be the content. You can look at the, so that we will be studying as well. You can look at this this note. It's in your file, in your folder. See this note?
Okay, sir.
You can start from there. You have to start from the basics. You can't go straight to Greeks. First, you have to go to the Turkish, and then you go to Greece. Okay. First, you have to start
Okay.
from the basics. Okay. So you can start.
Okay, sir.
All right.
Okay. Thank you, sir.
And yeah, then please make sure everybody start making
Sir,
your, yeah, yes.
sir, I'm having an issue regarding locating this file last time. So, could you paste this link of this drive file in the mail if it is not an issue?
No, it's not an issue, but we also want to make sure that what is the, you don't have access to the Google Drive.
Sir, it is already in the mail. You have floated the mail with the link.
Yeah, I have already given you the access. Yeah, with the, what is the problem? I'm not able to start. I don't have a problem helping you out, Surya, but I'm just concerned that why are you not able to? That means there's a learning for you there. Are you not able to access?
I mean, I reached the note master last time by simply using the. I mean, first time I did it via email somehow, but next time I was not able to like find which mail was it or like via the drive. So I accessed it via the history, internet history next time, and I kept on doing it like that. The note master.
1 minute.
So there is a
This FDRM.
so there is a very simple solution to it.
Yeah, I'll just help him out. Once you can give him the solution later. Okay, Surya. First of all, don't say I'm having a problem. Say I have a problem. Okay. All right. Don't say I'm having a.
Yes, sir.
So nobody should mind. I keep correcting people's English in front of others, but then, as I said, I'm your coach. I have to correct everybody in front of the team. So please, this is like a one family. So don't be embarrassed. Okay. It's not meant to insult you, but maybe other people also need the correction. Go to my drive. Okay. Go to this drive menu here. Okay. Go to sorry, not recent. Shared with me. Go to shared with me.
Here.
Okay. Can you see here all these people who shared their material with me? I can see them. Okay, my PC is a little slow.
Okay, sir.
So you can see all the stuff that has been shared, the folder. So under shared with me, you will find this FDRM folder is available. Right? You should not have.
Okay, sir. Okay, sir.
You should know the right way to solve your problem. If you still have a problem, you are welcome to approach me. We'll further figure out what to do. But I don't want to give you a soft option. I don't want to give you a soft option, a solution where you are prevented from actually learning what you need to learn. Yeah?
Okay, sir.
What's up? Okay, so you can just inform him about what you were suggesting.
Sir, the mail that you have sent, he can simply star it as well. The link which is containing the drive, the shared link.
Okay.
He can star it as well and he can access it from his email ID whenever he wants.
Yeah, okay. So this method is also fine. What I taught you, what Utsav is also saying that you can also do. So anyway, okay, guys, any other question? No more questions. Okay, so I'll see you guys about 1 week later. Okay, take care. Please work diligently. Make your own notes. Otherwise, you will have problems. Make your own notes. Go through the videos, notes, and make your own notes. Okay, I'm warning you from before. Otherwise, you're not going to learn. Okay, take care, guys. I'm stopping the recording.